Hello, I'm a 21-year-old investor looking to compound my wealth in the stock market. This is my portfolio holdings here. It's currently doing decently well. So Google is still the largest position by far, currently around 12% of the entire portfolio. Next one is ASML, followed by Visa as well as Mastercard. These two companies have been heavily adding into them over the recent days. Singapore is my Singapore investments, S&P Global, Amazon, Microsoft, Meta, MSCI, as well as FICO. So I've actually sold entirely out of my United Health holding. This is one of the lower conviction bets that I had in my portfolio. And Visa and Mastercard presenting the opportunity today actually gave me the chance to swap out of my United Health positions into Visa as well as Mastercard. So United Health I viewed as a company that is a good investment. It wasn't a good decision, but it turned out to be a decent outcome. Considering that I added my first position at around $400 a share, it's pretty decent. For United Health, I still view the company as attractively priced today, given the profit margin increases that it will experience in the coming years when your insurance premiums start to increase again. But for United Health, the company is simply one that I don't really have conviction in. It's a company that is extremely complex. I mean, most investors in United Health don't really know how exactly they're making the money that they are claiming on their income statement. So for United Health, that's why I sold out of the position, given that Visa and Mastercard were actually presenting good opportunities in the market today, and they still are. So the first company that I'll be covering today is Visa. So this is Visa's P ratio over the past 10 years. Let's take a look at this one. So they are currently trading at a GAAP P ratio of around 31 times. On a normalized P ratio basis, the company is currently trading at a 28 times price to earnings. So this is if you're to remove the litigation expenses. These are one-time expenses that the company is facing today, but it's non-recurring, of course. So over the past 10 years, median PE 33 times. And for Visa to trade at 28 times, the last time it was this low was in July of last year, as well as in 2022. So EPS has been growing quite steadily as well. This year's EPS is lower because of your litigation expenses. But over the past few years, the CAGR is around 17%. This is a company that is basically a toll booth. And profit margins wise, this company is giving you around a 50% margin. So it's one of the highest quality companies out there in terms of profit margin. So imagine you have $2 passing through Visa's network. They collect $1 from it. That's how incredible their business model is. So for Visa and Mastercard, you actually have a lot of different catalysts coming up. So for example, next year in 2026, you have your US World Cup coming up. This will drive cross-border transactions into the US, which will artificially boost up Visa's earnings in next year. And besides that, the US devaluation is actually favorable for Visa as well, given that a lot of their revenue actually comes from outside of the US. Similar for Mastercard also. And adding on to that, you have stimulus checks from the government, which is pushing up consumer spending. You have the stock market going up to all-time highs, which is also making people feel richer. I've covered all this in the Substack that I've posted. Feel free to check it out if you're interested. It's a short write-up on Visa and some other holdings that I'm currently having. So we'll take a look at Visa's valuation. So this is a small and short EPS calculation. You can try and do this also. This is a simple valuation method that you can use to craft out sort of like a napkin number, a napkin analysis of the company. So Visa today is currently trading at a GAAP EPS of around $10.20. So assuming an EPS growth of around 13%, which I think is reasonable for the company, analysts are also estimating something similar. They're actually forecasting a decline in terms of consumer spending in the US. I think in the Trump administration, as long as we don't have an AI bust, consumer spending will probably continually go up, given Trump likes stimulus checks and he likes to stimulate the entire economy. This is not their normalized EPS. So assuming a 31 times price to earnings ratio, Visa today is currently trading at around a 13% CAGR over the next 5 years. So if you're to normalize this P ratio, the company is actually trading a lot higher. So let's try and normalize the P ratio. So this is Visa's normalized P ratio, assuming a 28 times price to earnings, which is its current P ratio, so no multiple expansion, and assuming a 13% EPS growth, as well as the normalized earnings of around $11.05, the company today will give you returns of around 13%. So I think Visa today is presenting a good opportunity, and it's one of the most predictable companies out there. with a very reliable business model. Next stock that I'll be covering in this list of holdings here is Google, my largest position by far. So let's take a look at Google's fundamentals as well as its earnings profile so far. So Google is currently trading at a P ratio of around 30 times. So EPS has grown steadily as well, but a lot of this is actually bumped up by non-recurring earnings. So they actually included a lot of the gains from their investments like in Anthropic as well as SpaceX. So if you were to remove that portion, the current earnings for the company is around $9 per share. And the profit margins for Google has also crept up, I believe. So profit margin now is at around 32%. So this clearly shows that the company's investments have paid off. ROIC is also at a healthy 30%. This is one of the highest in terms of your hyperscalers. So your ROIC is actually your net income divided by your invested capital. So what Google is doing today is they're spending a lot of money on CapEx. So what that means is your invested capital will start to increase over time. And in order for them to maintain a healthy ROIC, your net income, which is the one above, has to at least grow as fast as the CapEx, or if not faster than the CapEx, in order for them to sustain a higher ROIC, which is what Google has done in the recent quarters. They've proven that they're one of the winners in terms of AI, which is why the stock is up around 100% since the lows in April. So let's do a valuation for Google today. So for Google, the current EPS is at around $10 a share. So Google at today's multiple of 30 times, I think it's unsustainable. For Google, I think a more reasonable multiple to pay is around a 25 times. And at around a 25 times price to earnings, this company will give you a return profile of around 10% over the next 5 years. This is without discounting the fact that they actually had a one-time earnings boost because of the SpaceX investment as well as the Anthropic investment. So if you have to discount for that as well, Google is currently trading at around an 8% CAGR over the next 5 years, assuming the P ratio is at around a 25 times. So why exactly is the P ratio put at 25 times when Google is clearly an AI winner today? It's simply because Google search is still under attack, of course. They still have a lot of their revenues coming in from Google search. It is one of the Max 7 companies that could be disrupted in the future. People often underestimate the risk of disruption. This was what Chris Holmes said when he sold out of his Google position. I'm sure he's thinking about the risk of disruption and how people today are underestimating it. So you can't discount the fact that Google has some risk of disruption today. So my initial investment into Google was a value investment. So at that time, people were bearish on the fact that ChatGPT was going to replace Google and Google's search revenue will start to decline or decelerate over time. And for Google search, there is no barriers for people to use the product. Whereas for ChatGPT, you have a limit in terms of the amount of usage that you can have on the platform. You have to pay a subscription in order for you to continue doing so. And if you already have a Google search, then there really isn't any incentive for you to want to switch over to ChatGPT. That was why I made Google one of the largest positions in my portfolio. In fact, it's the largest. And this narrative I feel has played out already. The sentiments now are bullish on Google. And I'll be holding off the Google investment in the coming months, but it is richly priced today. Next company that I'll be covering in this list here is ASML. It's my second largest holding in my stock portfolio. So for ASML, let's take a look at some of the metrics. So for ASML, the current PE ratio is at around a 35 times, which is right around its median. The EPS for this company has been growing steadily as well, although it's cyclical of course, given it's in the semiconductor industry. Profit margin has been increasing over time because the company is trying to shift from a pure hardware company into a maintenance-based company also. It's similar to your aerospace companies where you have maintenance contracts to service the machines that they sell. So similarly, ASML has the IBM portion, which is the installed base management portion. This is the recurring revenue that ASML collects every single year, where they can increase the prices and it's highly predictable revenue coming into the company also, which will of course increase the operating leverage for the company given the fixed costs will remain almost unchanged. And besides that, ASML has very healthy ROIC. The ROIC for the company is around 20%. So let's walk through a valuation for ASML that I built out based on a 2030 guidance. This is just some napkin numbers. So based on a 2030 guidance, assuming a price to earnings ratio of around 30 times, the company's fair value is around $850 a share. So low case, it's around $570 a share. High case, it's around $1,200 a share. So based on the base case scenario, the company is currently around 20% overvalued. But of course, ASML is one of the highest quality companies out there. There is no other company that is able to produce the technology that ASML has in terms of their EUV division, apart from in China. Of course, the China risks are real and it shouldn't be discounted also. So for ASML, the thesis surrounding the company is number one, your AI revolution. It's my bet in the AI revolution. And besides that, Trump is also trying to bring in all the different fabs into the US, trying to make chip production even higher in the US itself, rather than being reliant on Taiwan, on South Korea, and so on. And when you build more fabs, what that will mean is you need more ASML machines. So we've seen investments by TSMC, we've seen investments by other companies outside the US coming in also. This will all flow down to ASML and this will eventually have to pass through ASML, which is why I'm bullish on the company today. But of course, the company is currently trading at a steep valuation. I don't think the company is a buy today. It's a hold for me. And then following that, I'll be covering Mastercard also. So let's take a look at some of Mastercard's valuation metrics and so on. So the company today is trading at a 33 times price to earnings. The median over the past 10 years is around 38 times. EPS grows steadily also. So EPS CAGR over the past few years is around 18%. And this year alone, it grew EPS by around 15%. So profit margin growth has been larger than Visa also, although the profit margins are still lower than Visa. So the key difference between Visa and Mastercard is the dominance in US. So Visa is more dominant in the US as compared to Mastercard. Mastercard targets more of your lower developed countries as compared to Visa. That's why the profit margins are a lot lower in those countries there. But same thesis holds for Visa as well as Mastercard. They both have secular tailwinds coming in. They are catalysts next year, and I view these two companies as attractive today. So ROIC for Mastercard as well is around 40%. This is incredible for any company. And let's do a slight valuation for the company. So this is a valuation for Mastercard. So assuming the company holds the P ratio of around 30 times, the current P ratio is around 33 times, and assuming a 15% EPS growth for Mastercard, which is entirely possible, given the fact that Mastercard is venturing into your lower developed countries, which is leading to more growth as compared to Visa. And at today's price of around $525 a share, the company will give you returns of around 13%. So this is attractive given the markets today, and that is why I've been adding heavily into my Mastercard position as well as my Visa position. So the next company that I'll be covering here is Amazon. So Amazon is around 5% of my entire portfolio today. So let's take a look at some of Amazon's valuation metrics as well as their return profile. So for Amazon today, the company is currently trading at around a 31 times price to earnings ratio. So let's try and remove the 2022 portion. So over the past 2 years, the median P ratio is around 34 times. So besides that, for Amazon, the company's profit margin has been growing steadily over time. This is one of the theses for Amazon, which is profit margin expansion. So the company is artificially suppressing its profits because it's trying to drive up user growth, trying to expand its market share into all the different departments. But once they start pulling the levers, once they start increasing prices, in terms of your subscription, in terms of gaining more market share in advertising, this will help to boost up Amazon's profit margin in the coming years. And it has been going in the right direction in terms of trend. So ROIC metric for Amazon is a lot lower than your other hyperscalers. This is the problem with Amazon today, which is why the stock is selling off. So your ROIC profile for this company is around 12%. Amazon has historically piled a lot of money into capex investments, and the company is long-term focused rather than trying to gain short-term earnings returns. So the reason why Amazon stock is down is because they actually initiated a bond sale. So for Amazon, of course, you have the AWS portion that is growing slower than your other hyperscalers. And also the market is punishing the fact that Amazon is raising debt, similar to what Meta has done. And that is why Amazon stock has been selling off over the recent days. So for Amazon today, just to play around with some numbers, the company at 28 times price to earnings ratio, if the EPS can continually grow at around 15%, will give you a return profile of, I believe, around 12%. So Amazon today is around fair value. My model puts it at $212 of fair value. I think for Amazon, the problem with the company is the fact that your AWS portion isn't growing as quickly as your other different hyperscalers. And given the amount of capex that they're pouring into it, the markets are expecting more in terms of growth. I agree with the market reaction to this. I think Amazon's management has to deliver greater returns. If they're pouring $100 billion into capex, there has to be a certain level of ROI. And if the ROI isn't great, then they shouldn't be pouring money in the first place. Of course, your AI portion makes up a substantial amount of the entire net income, but you have other levers to pull also for Amazon. They're not entirely dependent on the AI portion. They have the retail portion, which they are extremely dominant in. They have the advertising space, they have subscription, they have all the other revenue streams that the company can pull and try and increase in terms of profitability. So for Amazon today, I view the company as fairly priced. It's okay if you're looking to add into this position. I think it's a decent buy today at current valuation. Last company that I'll be covering in today's video is also another company that I view as attractive today. This company is Meta. So Meta at today's price to earnings ratio is around 20 times, assuming they remove that one-time tax expense. This is on the lower side for Meta, although it traded down to around a 9 times of earnings at one point. So current EPS is growing quite steadily also, EPS growing at around 23% over the past few years. Profit margin has been increasing over time also. So this is clearly a sign that your AI investments have been working out for Meta. And I'm not too sure what the streets are worrying about because Meta's ROIC has been great in the recent years. So Meta's ROIC is currently still at around 37%, despite the massive ROI that the company is pouring into investments. The ROIC today is only second behind Google, and ROIC, which is return on incremental invested capital, which is your increase in net income divided by your increase in your invested capital, is still only second to Google in the entire AI space. So for Meta today, the reason why the stock is falling is because of your capex investment, of course. But let's do a slight valuation for Meta stock today. So assuming a 22 times price to earnings ratio and assuming the EPS grows at around 15%, Meta at today's price will give you around a 12% return on its normalized EPS, of course. So the P ratio is on the lower side. If you were to bump it up to something similar to Google, which is what I forecasted at around 25 times, then the return profile at today's price will be a lot more attractive. So the markets today are fearful of the fact that Mark Zuckerberg is spending a lot of money into capex, and what Mark is doing is he's actually widening the bell in terms of return profile. So you can get very good returns in Meta. You can also get very poor returns if all this capex don't pay off. So for Meta today, I view the company as extremely attractive. The narrative can just change very quickly if Mark Zuckerberg pivots into saying that your capex investments will be lower than what they have forecasted, or that they'll be more careful in terms of their spending. This will be something similar to what we saw with Google, where a narrative change can just simply switch up the stock price. So for Meta, it's a company that I've been adding into. It's currently around 4.5 or 5% of the entire portfolio. I'll be adding on the way down if the company continually falls. I hope you guys have found this video useful. Feel free to check out the Substack and invest safe.